Have you ever wondered how the world's biggest toy store, a luxury hotel empire, and your family's genealogy website all ended up under the same roof? Here's a hint. It wasn't magic. It was private equity, the silent force reshaping our economy, deciding which businesses live, die, and dominate. And guess what? Most people don't even realize it. In this video, we're going behind the curtain of private equity to uncover exactly how billionaires multiply their fortunes, why ordinary people feel left out, and how someone just like you can actually get a piece of the action. We'll also explore the psychological barriers that stop even the most ambitious people from taking action, and how to finally beat them. Before we dive in, make sure you hit that subscribe button. If you're curious, driven, and maybe a little lazy but still dream big, this channel is your new home. All right, let's get into the world of money, ambition, and motion. Private equity is a financial powerhouse, and firms like Blackstone, KKR, and Apollo aren't just playing in the sandbox. They own the sandbox. They own real estate, media companies, infrastructure, and yes, even Legoland. Here's how it works. Private equity firms raise money from investors, usually pension funds, governments, and ultra-wealthy individuals. They put that money into a fund and use it to buy companies. But they don't just buy them and sit back. They reshape them, restructure leadership, cut costs, inject capital, and reposition the company to grow. Then they sell it for a profit, often a massive one. Take Hilton Hotels, for example. Blackstone bought it for $26 billion, injected $800 million, shifted its business model, and sold it years later for a $14 billion profit. Now that is flipping on a billionaire scale. But here's the kicker. They rarely use their own money. They borrow heavily. It's called a leveraged buyout, LBO. And they use the company's assets and future profits to secure that debt. If it works, they make insane returns. If it doesn't, well, someone else often takes the fall. Stick around, because in the next block, we're going to talk about how this system sometimes backfires spectacularly, and what that means for the economy and your job. Not all private equity plays out like Hilton. Let's talk about Toys R Us. Back in 2005, private equity firms bought it for $6.6 billion using an LBO. But unlike Hilton, they didn't inject extra capital to modernize or compete with rising e-commerce trends. Instead, they extracted over $470 million in fees and interest over 12 years. All while Toys R Us was collapsing under debt, it never had a chance to escape. The result? Bankruptcy. Over 800 stores closed. Thousands lost their jobs. And for what? A botched attempt at squeezing profit from a broken model. Private equity isn't just high reward, it's high risk. But even when the company fails, the investors often still win. Why? Because the system is built to pay them first. Now, here's where you come in. You see, the gap between the wealthy and everyone else doesn't just come from effort or intelligence. It's built into how they operate. They take action, often with other people's money. But many of us get stuck before we ever start. Why? Because of inertia. The same law in physics that says objects at rest stay at rest. You want to build a business, learn investing, change your life. But the first step feels too big, so you never take it. Here's how to beat it. Reduce the stakes. Start with something so small, your brain can't say no. Want to learn finance? Watch this video. Want to start a side hustle? Spend 2 minutes brainstorming names. Want to buy a business someday? Read one deal case study today. Momentum is real. And just like private equity, firms know how to flip companies. You can learn to flip your habits. Stay with us, because coming up, we'll reveal 3 more strategies private equity firms use to explode value, and how you can apply them in your own career. Let's break down the core strategies in private equity. 1. Growth equity. This is the quieter, steadier cousin to venture capital. Instead of betting on wild ideas, private equity firms invest in already profitable businesses looking to scale. Think of TikTok. ByteDance received capital from firms like KKR and General Atlantic to expand globally. No crazy risk, just serious scale. 2. Venture capital. High risk, high reward. This is where firms like Sequoia and Andreessen Horowitz invest early in startups like Airbnb or WhatsApp. Huge returns if it works. Massive losses if it doesn't. Remember FTX and Theranos? Yeah. 3. Distressed investing. Buying failing companies at a discount and turning them around. Sometimes it works brilliantly, like with Game UK. Sometimes it destroys more than it saves, like Sharon Steel. You don't need billions to apply this thinking. Want to build your personal brand? That's growth equity. Take something solid and scale it smart. Want to try a new side hustle? That's venture-style thinking. Willing to take on a failed project, fix it, and profit? You're already in distressed investing. What's stopping you from making your first move? Comment below and tell us your biggest inertia point. And let's talk about how to break it. How private equity firms make money before a single sale. You won't believe how much they earn from just sitting still. So how do private equity firms become filthy rich, even if the deals flop? The secret is in the structure. First, management fees. Private equity firms charge about 2% annually on the total money they manage. That means even without flipping a company, they're making millions just for holding your investment. Then come performance fees, typically 20% of the profits. If they sell a business for a massive gain, they pocket a huge chunk of it. But unlike regular business owners, they often use your money and someone else's debt to make that happen. But there's more. Because the debt is on the acquired company's books, it's tax deductible. So the company keeps more of its earnings. And because private equity firms usually only contribute 10% of the fund themselves, their return on investment can be 10x or more. Let that sink in. They risk very little of their own money, but walk away with massive upside. It's like owning the casino. And here's the wild part. Many of them don't even wait until the company is sold to get paid. They'll structure fees, dividends, and bonuses all throughout the ownership period. Profit is baked in. But remember, this isn't just about greed. Many of these firms do improve businesses, create jobs, and fuel growth. The key is in how they do it. Stay tuned for the final block, where we'll show you how to start thinking like a private equity investor, even if you have $0 in the bank. So, how can you start thinking like private equity? You don't need millions. You need the mindset. Look for undervalued opportunities. That could be a side hustle, a business for sale, or a freelance service no one's offering well. Learn to use other people's money. Partnerships, investors, or even sweat equity deals where you trade your time for ownership. Focus on optimization. Just like PE firms restructure companies, you can restructure your routine, your habits, your workflow. Where are you inefficient? Cut the fat. And most importantly, just start. Don't wait to see the whole staircase. Take the first step. Write 50 words. Make one call. Read one article. Because motion creates momentum. If you're serious about learning how to buy businesses without capital, how to negotiate deals, and how to build wealth from scratch, be sure to subscribe to the channel and watch the next videos. Hit the like button if this video gave you a new perspective. Comment below with one idea you're taking action on today. And don't forget to subscribe. We've got more videos that break down complex wealth-building strategies in a way anyone can understand. Until next time, keep learning, keep moving, and keep thinking like an owner.